Keith, always good to see you. I actually want to start, Keith, where Julie was just talking about, just some of the economic data we'll be getting, Keith, this week. Manufacturing, jolts. You saw the Fed's beige book there. I'm just curious, your views on the U.S. economy, Keith, where we are and where we're headed and how that's shaping your views of the markets. Sure, and always great to be with you, Josh and Julie. I think collectively, the data certainly shows the economy is cooling. And, it's collective. Like you said, the JOLTS number, which, Fed Powell watches very closely, I think is an important one ahead of the jobs number. And as Julie just mentioned, the Fed Fund futures is now pricing in about a 45% chance of a 50 basis rate cut. And I still think it's a bit of a coin flip based on Friday's employment report, but I think they have full justification to do so. When you look at their own dot plot, the unemployment rate now, today, is above what they thought it was going to be at the end of next year. So in our view, they need to start moving, and they should be more aggressive.
Is the equity market going to welcome that aggressiveness, Keith?
It's an interesting question because I think, one point of view is that if the Fed goes 50 basis points and as opposed to 25 basis points, that will acknowledge that it's maybe something worse, like the economy is in worse shape. But, from my perspective, if you started from today with a blank sheet of paper and you said to the Fed, here's the factors as far as where the employment picture is, their own neutral rate is around 3%, and this is the trend of the data, and you had no legacy issues, I think you would go more aggressive. And from a market perspective, if you only go 25 basis points, it's incremental. They're well above neutral. I think it would be better for them to go, and maybe there'd be a knee-jerk reaction, but ultimately I think it would be better for them to be a bit more aggressive here because we are certainly seeing cooling across the board. I'm interested, Keith, we talk about the Fed. It's September as well, obviously historically tough month to be long the market. As a strategist, Keith, how do you think about seasonality? How does that shape your views, at least in the near intermediate term here? Yeah, well, I will use seasonality in a weight of the evidence process. It's one factor, and it's not the only factor, but a couple of things do line up. I think everyone knows that September is a weak period. Historically, you can see in the chart you're showing right now that it is the weakest month of the year. And then the other thing, as you get into October in an election year, you tend to see a spike in volatility as anxiety builds up ahead of the results. And then after you get on the other side of the election, typically you have a relief rally and a sigh of relief. So I guess the way I would think about this is we still think the primary trend for the market is higher. At this point, we're sticking with that. We would look at pullbacks as an opportunity to add for that because we still think the probabilities still support a fourth quarter rally. If I could just kind of share maybe one more stat, we've been up 9 out of the last 10 months for the S&P 500. Historically, the next month after you've had that type of gains, you're only up about 33% of the time. But as you expand that time frame, the probability of success or moving higher increases. So that also kind of reinforces our main thesis, which is these choppy waters into the election and then a rally into year end.
And Keith, one of the other things that we've been talking a lot about, I know you took note of it in your latest note, is the increasing breadth in the market. For so long, we were talking about, stocks are being pulled higher by those 9 of 10 months by large cap tech. That's no longer really the case. And in fact, the S&P Equal Weight Index, I believe, closed at a record yesterday. It's pulling back a little bit here today. What do you make of that increasing breadth and kind of what it tells us about the sustainability of the rally?
Yeah, it's a good point. I mean, because we have seen a bit more of a defensive tone in the market, but you're also at the same token, you see financials make all-time highs recently, industrials make all-time highs, and as you just mentioned, the Equal Weight Index also making fresh highs. So after that correction in August, when you start to rebound, the one thing we look at from a technical view is participation, or what you just said, breadth. And the good news, on a 10-day basis off that low, we saw advances lead decliners by a margin of 2 to 1. Historically, that is statistically significant. And when you look at 6 to 12 months, the market has a high probability of being higher. Again, on a short-term period, sometimes you use a lot of energy and you have a lot of back and forth. But overall, that's a healthy picture. And it's good to see that there's more than one place for investors to allocate. And you're all actually seeing the percentage of stocks in the S&P that are outperforming over the last 3 months around 60%. That's a multi-year high. So I think that's good for stock picking again. Keith, I want to switch gears a bit and talk about gold as well with you. It looks like it erased earlier losses after that JOLTS data. The trends look positive from here, Keith? Yeah, from a portfolio diversification standpoint, we added earlier this year a modest position, and there's a couple of things. One, just from a technical perspective, it just made an all-time high. The underlying technical trends are very positive. You have central bank buying around the globe, especially with China. You still have a decent amount of geopolitical uncertainty, and it's also a hedge against dollar weakness as well. So you put all those things together, along with the Fed reducing rates, we think there's a place in a portfolio for at least a modest position in gold, and we think there's still upside to go for the yellow metal.
Keith, is there anywhere else, whether it's in stocks or other assets right now, that you think is being overlooked that investors absolutely have to be looking at?
Oh, that's a tough question, Julie. We ultimately, our favorite asset is still stocks. We just think we have to kind of get through this kind of sloppier transition period. So I still think that's the spot, and it's kind of boring because we still think U.S. large caps, and eventually we think money will rotate into tech. We don't know that it's oversold enough here yet, but besides that, we do actually also, looking at bonds, kind of plain vanilla bonds, they're acting like bonds again, meaning when we had the correction in August, they were actually up the most that we've seen in any correction since the pandemic. So I think just, it sounds boring and simple, but just going back to basic diversification works and sticking with large caps and higher quality at this point of the cycle makes sense. And then, using some of these pullbacks that we think we'll have, especially as we have anxiety into the election, as actually opportunities to pick up things that are cheap or are on sale.
All right. Sometimes boring works, Keith. That's just how it is. Thanks a lot. Good to see you as always. Really appreciate it.